If you're planning to retire in your 50s or earlier, there's two accounts that, in my opinion, you absolutely have to focus on building up in order to strengthen your retirement plan. The funny part is that neither one of these accounts are actually considered retirement accounts. So in this video, I wanted to explain the pros and cons to each of these accounts, as well as why they're so important to contribute to, in addition to your traditional retirement accounts like IRAs and 401ks, but not instead of. Hey everyone, if we haven't met yet, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors, where we give you the confidence and clarity that you deserve with your money. Traditional retirement accounts like 401ks, IRAs, and pension plans all have specific characteristics that make them what's called tax advantaged. Capital gains, dividends, and interest are not taxed while investments are inside these accounts, which allows your money to compound more over time, giving you better results by retirement age. But the trade-off for these tax benefits is that you typically can't touch these accounts before age 59 and a half without incurring a early withdrawal penalty. Just as a side note, I did make a video on a few different ways you can tap into these accounts without paying a penalty that I'll include at the end of this video. So while these traditional retirement accounts are great for saving for your living expenses beyond age 59 and a half, they may not be the best to support your lifestyle before age 59 and a half if you plan to retire before then. The first type of investment account that you generally would want to build up to support an early retirement would be the taxable brokerage account. There's several advantages to a taxable brokerage account. Number one being accessibility. So you can pull money out of this type of account at any age, at any time without penalty. Since it's not labeled a retirement account like I mentioned earlier, the IRS doesn't even get notified when you take money out of the account. They only get notified when you have any capital gains or reportable taxable events like dividends and interest in the account. But again, the main benefit here is that it's accessible to you anytime. If you plan to retire before age 59 and a half, you can take as much out of that account as you want to. If you're still in the accumulation phase saving towards retirement, taxable brokerage accounts also don't have any contribution limits. So all retirement accounts that we mentioned earlier, 401ks, IRAs, Roth IRAs, all have some sort of contribution limit that limits how much you can put into those accounts each year. So if you're a high earner and you want to maximize your retirement savings for an early retirement, taxable brokerage account does not have any sort of restrictions on how much you can save and invest in this account. There's also no income restrictions that dictate who can or can't add money to these accounts. So again, ultimate flexibility with this type of account compared to other retirement accounts. One of the most important pros to this account is the tax treatment. So while you don't get any tax deductions for contributing money to the account, and interest and dividends and capital gains are taxed in the year that they occur, you do get access to favorable tax rates for long-term capital gains and qualified dividends. So those tax rates can be as low as 0%, they can be 15% or 20%, but generally speaking, these rates are going to be lower than the income tax rates that you would pay to withdraw money from a traditional IRA or 401k. So there are a couple downsides to the taxable brokerage account that we kind of mentioned already. Number one is that capital gains, dividends, and interest are taxed in the year that they occur, unlike retirement accounts. So even if you don't withdraw that money, or even if you reinvest the money in the account from dividends, etc., you do owe taxes on that. So keep that in mind. As these accounts grow larger, dividends ultimately become a larger dollar amount. You may have to pay out of pocket when you file taxes each year. Another downside we also mentioned already as well is that you don't get any tax deduction to put money in these accounts. So again, for the high earners out there who want to contribute pre-tax to 401ks, I'm not saying don't do that. Just contribute to these taxable brokerage accounts in addition to the other accounts that you can get a tax benefit from, since you're not really going to get any tax benefit this year from contributing to a taxable brokerage account. So as it relates specifically to an early retirement, there's a couple benefits I wanted to point out with a taxable brokerage account. And that is that when you're doing Roth conversions, you can use money from this account to pay for the taxes on a Roth conversion. Roth conversions are a popular strategy among early retirees to, sock away more tax-free money from your traditional accounts. So when you pay for the taxes on that, you generally want to pay that money out of pocket from a taxable brokerage account or a savings account, rather than withholding it from your traditional IRA amount, because that's just going to result in less money going into your Roth IRA. And if you withhold taxes from the traditional IRA, that could be subject to penalties as well. So again, taxable brokerage account for early retirees is good for paying Roth conversion taxes. Another thing is that you can keep your income artificially low for ACA subsidies. So Obamacare, if you're an early retiree and you want to get the premium tax credit, you can utilize your capital gains in this account to keep your income low. For example, you want to take out $80,000 from your taxable brokerage account for your living expenses, but you have a capital gain on that that's only $30,000. So the $30,000 is all that's going to count towards your adjusted gross income, which is what's looked at for the premium tax credit when you're getting healthcare through the ACA or the Affordable Care Act. So again, tax flexibility is the theme here with this account. And as I alluded to earlier, capital gains can be taxed as low as 0% depending on your tax bracket that I'll put up on the screen here. But you can also take advantage of tax loss harvesting with these accounts, so you can reduce your income by a certain amount each year to offset gains or other income. But you can also do tax gain harvesting. Tax gain harvesting is purposely selling investments at a gain, but only enough to stay within that 0% long-term capital gains bracket, repurchasing your investments at a higher cost basis so that later when you actually need to sell them to pull money out, you're paying less capital gains taxes. So that's tax gain harvesting. Again, another kind of flexible feature of this account as it relates to early retirees. The second type of account that you want to focus on and build up for an early retirement is a health savings account. Traditional retirement age is, again, mid-60s. You qualify for Medicare at 65. If you plan to retire anytime before 65, you will need to pay for health insurance out of pocket, most likely, unless you have a spouse that's still working and they have access to an employer plan that you can get on. But since you will have to pay medical expenses out of pocket, an HSA is a great tool to be able to do that. Some of the benefits of an HSA are that they are what's called triple tax advantage. So contributions to an HSA are tax deductible. The growth and earnings inside the account are not taxed, similar to those other retirement accounts we mentioned. And then withdrawals for qualified medical expenses are tax-free. So no other investment account has all three of those. So HSAs are a great tool to utilize to take advantage of all those tax benefits. Just make sure that you invest the money in the HSA if it is going to be used for healthcare expenses years and years down the line. A lot of companies offer HSAs where it just sits in cash like a savings account. So make sure you have access to an investment account within your HSA. A couple downsides to an HSA. Number one, you do have to be enrolled in a high deductible health insurance plan, which is not suitable for everyone. So if you are someone with medical conditions or frequent doctor visits, a high deductible plan is probably going to cost you more on an ongoing basis for health insurance. So don't enroll in a high deductible plan just for the access to the HSA if it's going to end up costing you more money. Another downside to HSAs is that they do have relatively low contribution limits. So, they're not as high as 401ks or IRAs. So they do limit what you can put into them. But again, that's kind of the trade-off you get for being able to take advantage of those three tax benefits and use that money for healthcare expenses in an early retirement. The good thing though about HSAs is that at age 65, they basically just become another traditional IRA. You can take money out of that account for anything. You just pay ordinary income taxes on it, no penalties. But if you withdraw money before age 65 and use that money for anything but qualified medical expenses, you'll pay a 20% penalty in addition to taxes on the money. So as it relates to an early retirement, an HSA offers a couple unique benefits. Number one is that money can be used immediately at any time, just like a taxable brokerage account, as long as it's for qualified medical expenses. So you don't need to wait until 59 and a half. If you retire at 45, you can start using that money for your health insurance premiums. You can use it for anything that might arise as it relates to healthcare. So ultimately, it reduces your reliance on other retirement funds like your IRAs and 401ks, as well as your taxable brokerage account. So you can leave money in those accounts to continue growing and compounding over time for when you need it later. Also, since withdrawals from an HSA don't increase your taxable income, they don't affect your ability to do the tax gain harvesting that we talked about earlier. They won't affect anything to do with your ACA premium tax credit. So they're almost like a Roth IRA in early retirement that you don't have to wait till later to access. So in conclusion, I'll say this again, don't contribute to these taxable brokerage accounts and HSAs instead of your traditional retirement accounts. If you plan to retire early, definitely still contribute to those because you will have living expenses after age 59 and a half, of course. So contribute to these accounts on the side. Again, there's benefits to the taxable brokerage account for Roth conversions, for accessing money before traditional retirement age, and the preferred tax rates on dividends and long-term capital gains. And the HSAs are a great tool to be able to access money for medical expenses at any age, so you don't have to rely on other retirement accounts, allowing your money to continue growing for later. And as promised, there are ways to tap into your traditional retirement accounts before age 59 and a half. Here's the video on that if you want to check that out now.